hedge funds or any other investors that buy 5% or more of a company's stock are required to file either 13D or 13G with the SEC. The beauty of these filings is that, first, they're public record, so we could look them up. Second, they actually convey the filer's monitoring intent to us. A 13D is filed if the fund intends to engage in voice by pressing for specific changes in the company. A 13G is filed if the fund intends to remain passive and just trade, right? So we make use of these filings and study the effect of liquidity on these filings. There are several interesting findings in this paper. First, we show that the higher the liquidity, the more likely we're going to see a 13D or 13G, right? So that is, high liquidity encourages block formation. By block, we mean 5% or more. But conditional on block formation, we show that liquidity is more likely to lead to a 13G filing, right? Keep in mind, 13G filing conveys a passive intent. Is this no governance? That means they just trade. We actually show that a 13G filing represents governance by itself. We show that a 13G filing leads to a positive market reaction, a positive holding period return to hedge fund, and an improvement in firm performance. And all these effects are stronger in firms with higher liquidity, which basically says 13G filings represent governance mechanism by themselves. After the financial crisis, several EU countries are now talking about restricting stock market liquidity in their countries, right? But our findings seem to suggest that liquidity has potential benefits. So policymakers may want to, take a step back, think a little bit more before they rush into any regulations that restrict stock liquidity.